All right. And we are live. So, welcome everyone to the third episode of Future of Finance webinar and podcast hosted by the Big Whale. My name is Alex. I'm the lead research analyst at the Big Whale and your host. And if you don't know us, we are the leading digital asset intelligence provider in Europe. So, fully independent, fully institutionally oriented. We service our clients through three pillar service offerings. So our intelligence layer, our network, and also our curated events. So this is a monthly format, as you all know. We used to cover price more in price action, but now we pivoted towards more mature topics, what's actually brewing behind the hood. And today we are discussing one of the topics that, in my mind, is maybe one of the rarest proven use cases of the digital asset industry, which are stablecoins. But not stablecoins as a currency representative, so chain, but what's actually behind them. So the economic model, the wallet and distribution, but also increasing geopolitical sovereignty play. So I'm joined today by Alex, CEO of AllUnity, the issuer of three different stablecoins. So euro denominated Swedish krona and Swiss franc, and also Elie Naba. He's the CEO of Meridyan and also works at ABN AMRO, so bank based in Amsterdam. So guys, thank you for joining me today.
Thank you.
Thank you very much.
Thank you for having us.
Yeah, of course. Before we hop into discussion, I just want to remind our audience to ask questions. So your question will be directed. I'll read them out loud and direct them to our respected guests. So before we start with plan agenda, which is we're going to cover yield, we're going to cover distribution and wallet, and also we're going to cover non-USD alternatives in the stablecoin world. I want to hear your guys' takes on the endorsement of digital euro by European Parliament. 43 votes yes, 14 for no. So it's a huge win, largely skewed towards the adoption of the digital euro. So is it going to save Europe, or is it going to be one of these projects that you put in a drawer and forget about it in a couple of years? So Alex, we're going to start with you.
Thank you very much. Good question. Now, I think the fundamentals that is pushing the European Union to come up with a decision to get more sovereignty, independence from maybe US payment mechanisms perfectly makes sense. Whether a central bank issued retail instrument is the right one that is then distributed, limited in size, with the impression that the user sorts out which instrument he's going to use, and going live, even with this vote now, I mean, expectations is still 29. My point of view is a waste of time and resources, especially given the agentic payment speed that's on the horizon. Anything with a time horizon of 2, 3, 4 years is absolutely coming too late to the market. So fundamentally, the idea, the direction, 100% on the same page. Is this the right instrument? Is this the right issuer to do that? Highly questionable. And the timeline is a total no-go, especially in the new developing and agentic world.
Yeah, exactly. And again, echoing exactly the same points, right? So from a why is the ECB moving into that direction? I think the need for a payment instrument that is a public good. I mean, that's an obvious need for Europe. Public money is something that we need, and with the decline of the use of cash, there needs to be an alternative, right? But if you look at the implementation plans and the implementation costs as well, so some estimates around like 14 to 19 billion to actually implement these technologies, and what are the use cases with instant SEPA that is already very efficient, free, available to all consumers, and then you have stable coins, tokenized deposits. Banks will have to move into that direction, and then add on top of that also the digital euro. I mean, it just becomes a big mess for banks and for implementations in the EU. And then how will it actually play out? I mean, let's see. The ECB can actually mandate banks to actually move into that direction, and then will that basically move the market in the correct direction? I don't know. I don't still see the use cases for a digital euro. So where will we use it, and what will it be used for? So yeah, a big question mark on my side. And So yeah.
So I guess time will tell, right? And but 2029 is quite a stretch in my opinion. Like it's 3 years. It's a lot of time. A lot can happen in 3 years, especially in our industry. Like things are changing on a monthly basis. But do you think that market is like the use case field is big enough to accommodate so privately issued EMTs and the digital euro going in parallel?
Yes, I think so. I mean, when you look at take the US, how many payment mechanisms do they have? 14 or so?
Mm,
I just recently came from Japan. They all also
mhm,
have a handful, yeah, if not two handfuls, privately and governmental and what have you. So does it principally, is there enough room in the European Union with 450 million people for more than one, two, three, four payment mechanisms? Absolutely, yeah.
mhm,
And time and adoption will tell which are the necessary one and the right ones. The issue is with all the discussion around digital euro, go down the street, ask the people whether they have a payment problem. The answer will be
mm,
no. So it is a problem from a, let's say, European Union perspective, it's a problem. But the people on the ground, they don't have a payment problem and they don't necessarily
yeah,
understand that there is a payment problem. And that means whatever we bring to the market needs to be more comfortable, more usable from the
Mhm.
user experience, faster and cheaper than anything else that we have there. And I just imagine what the current providers are doing over the next 3-4 years. They're not sleeping and waiting with what's coming. So that's a race you can't win. Yeah. Is the room there? Absolutely. Is there enough, let's say, monetization possibility in that one? Prices are still pretty high. Yeah. So yes,
mhm,
absolutely. But this will be a tough race. The others have tens of years in advance,
and
and you have to catch this up in just 2-3 years, and that's even too long.
yeah,
Yeah,
yeah.
absolutely agree. I mean, nothing to add on top of that. Where will it be used, and how can you beat actually, let's say, the experience that most of us do today, where you click two buttons on the side of your phone and then you tap and then you've paid already, right? What is the user
Mhm.
experience that you can create that can be superior to that in order to incentivize users to use it?
Yeah, that reminds me about like like they're trying to reinvent hot water again. Like don't do that. But yeah, thank you guys for your takes. Before we jump to the yield questions, Alex, you just returned from Japan, and Japan, if I'm not mistaken, recently launched an initiative to kind of stimulate the issuance of yen-denominated stablecoins, and we see that they are hiking rates. So maybe in the future there will be a economic incentive for issuers to hold Japanese bonds. I can't believe that I'm saying this, but it's already above 1%. So what was your scope from the ground when you were there?
Yeah, I mean, our direction is cross-border payments, and recently the Japanese regulator announced that they will allow foreign-issued stablecoins to be approved via a different structure, not via the typical type 1, 2, 3 and
Mhm,
locally on the ground issuer structure or trust bank structure, but via a specialized broker-dealer license that allows actually to offer the stablecoin within Japan without having to have a license on the ground, which is a model that we also see in Taiwan. Yeah, and a very interesting model. So it seems that within Japan, interestingly, within Japan, the direction of a lot of the big banks is stablecoins for retail payments, which is, let's say, similar to the digital euro, where I say with all the payment mechanisms that they have, what's really the use case. Then they focus very much on deposit tokens, understandably, like in Europe, because you can use your own bank balance, benefits and that and that. But they fully acknowledge that when you talk about multinational TradFi aspects, deposit tokens will have an acceptance issue.
Mhm.
Global payments on deposit side with Agora introduces another intermediary, which eats the efficiency. So deposit token in the universe, fantastic. Stablecoins, interestingly, for retail on the ground, but more also now for cross-border payments and capital optimization, traditional finance, trade finance. So pretty similar actually to the developments that we see here, and they are speeding up.
mhm,
So it was, let's say, quite a discussion a few months ago, and now you see more and more players jumping onto that field, more and more players coming to that. So
mm,
it's really speeding up the market.
yeah, I see. I see. Cool. So let's jump to the first batch of questions about yield. Of course, that's the hottest topic when it comes to stable coins, and we know that Genius banned the yield like users cannot access the yield from issuers, like it cannot be transferred to them. There is like economical value transfer. But Alex, when you and I talked earlier in February, you explained me an alternative business model and use case that you are building at AllUnity. So what's the issuer model in your mind that can effectively scale in Europe and become self-sustainable in, let's say, next 1 to 2 years?
So firstly, the ban of interest sharing for token holders is more or less taken over by all the regulators that are currently working on stablecoin regimes. So there's sort of an interoperability already forming regarding that aspect. Now with Clarity, there seems that you can have sort of a technical integration fee. No wonder will be the same size as the interest. So for me, that's a little bit a circumventing mechanism to pay the interest. And if you see that on the US side, you will most likely also see it on all the other jurisdictions. But leave that to the sideline. If we have the predominant means is still interest on the reserve. Yeah, but when you look for cross-border capital optimization, trade finance, and the likes, you have huge efficiency gains, and therefore you can be much cheaper than the market is offering today, because you're adding more variety in FX rates, you're adding more variety and whom to pick and choose when it comes to the transaction. But that doesn't mean that a transaction has to be for zero cost. It can be 1 basis point, it can be 2 basis points. When you look at the trading balance that the European Union is doing with other countries, and you imagine that parts of this is tokenized, yeah, and the large part of that still runs off percentages for cross-border payments, and you go down to 5 basis points or 2 basis points, that's still a lot of money. Yeah, so I think you will have transaction fees depending on what is the use case, and you have the interest-bearing aspect, and that's way enough. There might be other services coming to that, but I think these two already are pretty strong. And if the regulators will allow us some technical integration fee, fine, but it's not necessarily the thing that is needed from my point of view.
Needed. And to that point, so we are seeing more and more kind of people opting for a yield product that's actually tokenized money market fund. So, and I want to ask Elie this. So, where does European demand for yield bearing exposure actually get satisfied in your mind?
Yeah, that's a very interesting question. And now actually to come back to it, to break it down actually. So today, what we see is the business model of stable coins is basically what I want to try to do is I want to keep as much reserves as possible within my stable coin in order to earn yield on the reserves. That's basically the business model of all stable coins. And what we're seeing is that actually since you have no incentive as a user to keep capital within that stable coin, then potentially as the world of more yield-bearing tokenized assets grows, what will happen is stablecoins would just become like a messaging layer between one yield-bearing asset and another. So imagine you have tokenized money market funds and you want to pay somebody in Japan, so you switch into a stablecoin, you pay that person in Japan, and then again here in Japan, they switch back and they go into a yield-bearing instrument. And I think this is basically one of the features of the decentralized finance of the on-chain world is it was never the intention to actually have stablecoins grow so much that basically all liquidity is trapped into it and basically taken out of the economy and either parked at the ECB or at another central bank, but to actually allow that capital to actually circulate in yield-bearing instruments. And today what we see is money market funds are leading on that front because they are, let's say, the first use case where we saw actually tokenized assets that have yield come on chain. But what would become more interesting is once we see more tokenized assets, like, I don't know, an investment in a company that is doing something very efficient in Spain or in Germany or whatever, and then you as an investor, as a holder of a stable coin, have the option to actually go into that yield bearing instrument immediately, right? So you just use your cash to circulate it whenever you need payments, and whenever you need to park it, you can actually go and invest in a very innovative company instead of just, let's say, keeping the cash in money market funds. And I think this is going to be huge if we actually manage to pull that off, at least for Europe. I mean, there's a clear push to have more tokenized assets brought on chain. The Savings and Investments Union clearly states that DLT could be something that can catalyze the industry, and let's see how that actually
Mhm.
plays out. Yeah,
Yeah.
May I add to that? I 100% Ellie. And this is exactly why I think this whole discussion about stablecoins are not paying interest is a false discussion.
exactly.
Mm,
The benefit and the beauty of tokenized assets is the speed. The
mm,
average round trip time for us is 4 minutes back and forth. So you get your money early, fantastic. Redeem it, invest. Ideally, you don't redeem it, you invest it in a tokenized version, in a tokenized money market fund or other yield bearing instrument that pays interest on an hourly basis.
Yeah,
Fantastic, do so. I mean, on cash, I don't also on normal banks get any money. Yeah. And if a treasury head wants to get interest, they need to get it off their balance, get it to the bank puts it overnight, and then they get the interest. So all these discussions, oh my God, stablecoins are not
exactly.
paying interest. Who cares? You just redeem it or you just invest it on a tokenized basis, and then you have your instrument. So this
mm.
is really, from my point of view, a fake discussion. 100% on your side. This will be stablecoins are just a means for the transaction.
Yeah, yeah. And what's interesting actually in this tokenized space is actually having decentralized issuance of let's say
Yeah.
equity, right? Having anybody, let's say, that is regulated, that has the licenses, that has the business model, to have the ability to issue either equity or debt on chain and offer that to consumers. So let's say a world that I keep imagining is I see a company in Spain that is so innovative and I want to invest in it, and with stable coins, with tokenized assets, I have the ability to do that instantaneously. That's actually what we're working towards in Europe.
Perfect. Yeah. Now it's funny that you mention any kind of feeds into my next question for both of you. This interregional international payments. So we hosted a panel in Amsterdam. Elie was present there during Money 2020. So we had Defense and Kilolis. And Clarice argued that one of the use cases of the stablecoins, or one of the major disruptions in the future, will be to remove or eliminate correspondent banking. What are your takes on that?
I'd say this will still take a little while. Yeah,
Mm-hmm.
maybe as soon as we have a tokenized money market fund or something similar as a global reserve pool, then we might move around that. We all stablecoins currently face still the on and off ramp issue. Means as a
Mm,
European, I want to send euro. As an Australian customer, I want to receive Australian dollar. Now, forget about the FX for a second. You send the stablecoin in a second. You want to off ramp in Australia, the money is still in Europe. And then you have to use the corresponding banking system to
Exactly.
get the money over to Australia. Now, I think we are still in an early stage because we should not forget that the regulatory framework is just developing, and the only really one in place is now maybe Hong Kong and Europe. Clarity is not done yet, and Genius is not done yet, and UK is working on it, and Switzerland's working on it, and everybody's working on it. So that's the first thing. The second thing is that you have this issue of on and off ramp still, but this is really at the beginning only also an issue if you think about single transactions. If you think about a lot of back and forth going on and you do sort of a day end netting of the off ramp, then you have already a lot of the efficiency. But the real deal comes where, as Elie said, when you have a fully tokenized global available pool that you, while you invest, has the reserve, and the reserve gets also FX'd when you send the stablecoin somewhere else, and then you can locally off ramp it. But this is not there yet.
Yeah, I would argue that maybe stable coins become a global instrument, but investment would be global, right? That's what we want in Europe. We
Yeah.
want to keep the liquidity inside of Europe, right? So you would invest in European companies, and then you would do that. But then coming back to the question, so if you look today at a company like OpenFX, right? Like there's this big critique on the end of correspondent banking. But what OpenFX is actually is it is a form of correspondent banking where you have different liquidity providers around the globe that provide
Yeah.
liquidity for a stable coin, and that's basically it. So it's it's actually a more centralized form of correspondent banking that where today exists, where what we're saying is we have one liquidity provider in each point of the globe, and what we do is we circulate stable coins between them, and every time a customer wants to switch out, then somebody provides that liquidity in the end, which is basically a form of correspondent banking, right? So yeah. those are basically the biggest companies today in stablecoins and the stablecoin ecosystem.
Mimicking correspondent banking on chain.
Basically.
Value proposition. Yeah. Okay. So before we move to the sovereignty part, I have two good questions. So the first one is from Andrea, and she asks why to use stablecoins and not tokenized deposits for settlement of transactions in asset management.
I
Alex, you
personally,
can take it. Okay, Elie. Yeah.
I personally really believe in tokenized deposits and asset management in securities transactions. But the problem is, so it's for me the model is like how does the relationship build up? Is it like a bank offering tokenized securities to its clients? Then here it's of course tokenized deposit that works. But if it is, let's say, a group of banks that want to pool liquidity inside of a tokenized security and make that security liquid, then here tokenized deposits don't work, because basically you need a unified cash leg to actually make the exchange happen. You actually to make the token liquid, and so this is basically where stablecoins happen. So again, it's like it depends on the relationship that exists between the asset manager and the selling venue. That's what I would say, and the liquidity nature of it. Alex?
Perfect.
Nothing to add to that. I agree. For asset management, I would probably do the same, especially when it's in the ecosystem of the bank. The deposit tokens, from my point of view, have a if you want to say so, a drawback when you go beyond the ecosystem that accepts the deposit. If you have a multinational thing, and then every bank comes up with its own deposit infrastructure, and then they want to do transactions in between, then it might be difficult. If you have one bank that offers a deposit token margin instruments or assets, fantastic, perfectly works. You don't need a stablecoin. It's much more efficient in that ecosystem. So I'm nothing to add to that, Elie. 100%.
Yeah. I have a question for you, Alex. So it's from Vincent. So he says, Alex, sorry, but I didn't get why you don't think the ECB initiative on a native euro stablecoin is not the right idea. It will be the first stablecoin with zero DPEG risk that anyone will be able to use for atomic swap operations. It should actually unlock the risk and de-risk on-chain trade, don't you think?
Okay, it's a question how much time
or
we have.
off-chain.
So, okay, what we call stablecoins is only used for e-money tokens. So tokenized versions of e-money. Although also CDBCs and deposit tokens are technically also stablecoins because it goes to the asset and not to the issuer. It is only used for e-money tokens. The difference of the tokens is just the difference of the issuer. There's nothing to do with the technological risk. So the risk is technically the same. The issuer risk is a different one. The risk of depegging, or if the instrument, I don't buy this thing, because when you look at what ECB wants, it wants to use the digital euro as a countermeasure for e-money. Not e-money token, for e-money. So for PayPal, Google, MasterCard, and Visa, because that are the predominant schemes that you have right now and the dependence to the US. Stablecoins, which are the tokenized versions of e-money, have usually a totally different use case, which is cross-border payments. So not what e-money is on a large scale for enterprises used for. For private persons, MasterCard, Visa, PayPal, absolutely. But let's say on a big scale, you have different means like SWIFT. So we are arguing digital euro against stablecoins, which is not the right thing. It's digital euro against PayPal, Visa, and MasterCard, which is e-money, and stablecoins are targeting SWIFT. So a totally different layer. Now, if we define digital euro up to 3,000 euro, you don't have a risk anyway, because the digital euro should be issued by the banks. The banks have the fail-safe of 100,000 per account anyway. So whatever depegs or doesn't depeg, you get your money back. So you don't have to have it for 3,000 euro. And when you go to the depegging thing, the digital euro is backed by the central bank. Yes, but the stablecoins that we have has to be 100% collateralized by the definition of the law. So the depegging risk that you for stablecoins, so e-money tokens given by e-money institutes regulated in European Union under MiCA, only depeg, they cannot depeg. The risk is only if the euro has a problem, then naturally the reserve has a problem, and then your stablecoin has a problem. Now, you could argue, okay, but Alex, you can invest up to 60, 70%, depending on how the structure is, into high quality liquid assets. And theoretically, these high quality liquid assets could fall below par, which would then force you to add the equity requirements to be able and solvent to pay on par. Yeah. But this is exactly why the law is like this. So going back to the example of deposit tokens, a bank has to have an equity requirement of what, 8%, 12%? Yeah, give and take. Yeah, stablecoin issuer has to have 100% plus 2% or 3%. So by definition, the collateralization is much bigger. Plus, stablecoin issuers have to spread their reserves over various banks. You could argue that this is less risky than having all the reserves with one bank. And technically, e-money institutes are allowed to put the reserves on the central bank accounts. This is currently not wanted, but technically it's allowed. So if they would allow us as we can, then the reserves are with the central bank, and then this argument totally falls away. So from my point of view, the argument for this, why I think it's not a good idea, sorry for the length here, I try to be fast, is
Good
the
explanation.
central bank usually does only wholesale large chunk things and very sophisticated between governments, between countries, and between large corporates. Why they are the best ones to define something which is user-centric, I have a big question mark, and then anything that limits the usage in size, instrument, volume, whatsoever, from my point of view, cannot work because you as a user, you just want to pay. And if something costs more than 3,000 euro, which can happen, then you can't use the instrument. Or how should it work? And then to ask the question alone will show that this will have problems in the practical day to day.
Hope, Vincent, that answers your question. So yeah, good point on, he says, like, great. Good point on the diversification fact that you need to spread your deposits across many banks to remove the dependency on one single deposit holder. So okay, let's move to the second block of the question. So when I was in Amsterdam, I met with Elie privately, but also we discussed, like, the hottest topic was Kivalis, without a doubt. So we discussed it privately, but I just Elie, I just want to have your take. So 37 banks, euro-denominated stablecoin, Fireblocks as a custody provider. Is that a real competitive threat to standalone issuers? Or will it be a project that struggles to ship, in your mind?
Okay, so first of all, cheers to the Kivalis guys. I think they're the best in the industry, and I wish them all of the success. But I do have some doubts, just like that exist also on the market, right? So today, what we've said is, in order for a stablecoin to work, it needs to have liquidity behind it, right? So it needs to grow in liquidity. Now, today, what is the incentive of any of those 37 banks to remove liquidity from their balance sheet and pool it together in under Kivalis, right? So I allow my customers to move capital from my books, and then I put it with somebody else. Where is what is the incentive for that? That is still unclear for me. I mean, what I think would really make sense is if you were to imagine Kivalis as, let's say, this on-chain network of all of these 37 banks, where each of the bank manages their own reserves, but still the liquidity of the token, let's say, still the liquidity of that token is somehow the same on chain, and basically Kivalis is the token on chain that binds them all and then opens up the use cases that we expect to have. I think this would definitely be an interesting model to look at, but I don't think it is the current one today. Then again, for Fireblocks, I mean, there's a reason why they are the market leaders. I mean, it's also a great company, top of the line security and everything. But a few weeks ago, we saw how the US basically pulled the plug on Fable 5, right? And that was something that a lot of people were thinking, okay, this is the best model that's going to be on Earth, and let me start to think how I can bring that into my business. And now all of a sudden, no, I cannot use it, right? So is the question then of European sovereignty, is it only with the token that is issued, or is it, let's say, with the entire stack that powers that token, with the entire payment infrastructure that powers that token? I think this is where we where we hope Kivalis would take the industry. And I think, yeah, you can definitely use Fireblocks. It's top of the line technology, but you can also use other European tech stack providers to maybe diversify this risk that was really made clear to us by what happened with Fable 5, but also with other technologies as well, right? The whole point is reducing reliance
Yeah.
on foreign tech providers. That's the whole point of what we're doing.
Mm. Hannah asked a question here. So effectively, if you are Yancel, so what would be your KPIs that you would monitor?
I would monitor, let's say, so I wouldn't want to, it's a tough job that Jan has, right? Managing 37 banks with 37 different agendas. But what I would be looking for is what would be the distribution model that these banks would
Mm-hmm.
support? Is it that they're actually really invested in making this project work, or is it just a hedge that they're placing against the rise of stablecoins? How much liquidity would be provided by those member banks to actually cold start the token? Because in order for it to succeed, it needs to have substantial liquidity in order for it to be the giants that exist. I mean, today Tether is what, at 137 billion, and for you to be significant, you need to at least maybe capture, I don't know, 10, 20% of that. So will that also be provided by the banks? Will they also distribute those tokens to their clients? And I think those are the two biggest ones for me, I would say.
Okay, yes. All right. Alex, do you have something to add?
Yeah, I mean,
Yeah.
probably yes, but no.
Okay.
I think that no, I think one thing that is we have the discussions about fragmentation. We have the discussions about various players. We still have to see, and that's not meant negatively. What is really the model of Kivalis? Like Elie said, yeah, I hear several things, and when I talk to Jan, and actually he's not sharing it with me because I'm a competitor. I get this point, yeah, but I got more the impression that this is an interbanking thing, yeah, than other things. But we have to see, yeah, and then I can tell you more about it. We have one fundamental problem in Europe because we're discussing digital euros, CDBCs, deposit tokens, and stablecoins, and we're discussing it on a level. This is good and this is bad, and that's a good player and this is a bad player, and that's nobody offers wallets to their clients. And without a wallet, nothing happens. No asset tokenized, no deposit token, no stablecoin, no digital euro, no CDBC, no Kivalis, no AllUnity. And when I hear this, yeah, we're talking and circling around the wrong problem. It's not either or. It's an and for the instruments and also for the player. You will see fragmentation first, and you will see consolidation later when you see who will surface for which model. Yeah, it might be that we are special for one model, but Kivalis is special for another model, and somebody else is special for some model. We don't need 5. We need maybe 2, max 3, because privately issued, you don't want to have 1, but you also don't want to have 10. But this all is won't help you if none of the banks is actively offering wallets to their institutional clients. I'm not talking retail clients, I mean institutional clients. If you're a corporate, you don't want to do cross-border, or you want to do TradeFi, or you want to invest or invest into an asset, the US banks are on the forefront of offering directly wallets to their clients. Yeah. And I have experienced European banks sending their clients to US players because, hey, you want to buy this asset, you have to go to Coinbase. If that is what we understand under sovereignty, I think we're on the wrong ship.
Wow. So, so you would argue that we first need fragmentation, and then to kind of experience clear winners in each designated vertical, and then
I wouldn't argue
consolidation in Europe.
I wouldn't argue that we need fragmentation. I think it's obvious if you have a market with that potential that you see fragmentation. Everybody thinks it's super easy, and everybody will realize it's not super easy, and it's very expensive. And so this alone will drive consolidation at some point in time. And that you will see, this is when then surfaces that maybe Kivalis is perfect for one thing, and AllUnity is perfect for another, and maybe SocGen or who else is perfect for something else. And then you have your payment mix or whatever the ultimate players will be.
Quantos is also a good company. Quantos is also a good company.
Yeah, you have Quantos and you have, I don't want to pick and choose one. Yeah, it's just, you have also Monerium in Iceland. They are also good guys. Yeah, so I don't want to outrule anybody.
Yeah, I wanna to that point. So to kind of talk a little bit more about sovereignty. So you recently launched Swedish krona denominated stablecoin. So do you think that is that a successful template for non-USD and maybe non-euro denominated stablecoins, or like local currencies, or is it one of that wouldn't scale in the future?
Now you have to look into in which market. Do we think that you will see a BTC, ZK, a perpetual swap on Binance? Probably not. Okay. When you look at the trade balance that the Nordics are doing with the rest of the world, that's pretty big. Yeah. So there is definitely a market. When you look at agentic payments, which is an interesting one, yeah, then you will have micropayments, for example, for news, for content, or whatever. And if you're a Swedish citizen and you want to get that content, you don't want to convert your Swedish krona into US dollar to get the content. So you want to use your home currency. So that speaks definitely for an own currency to be tokenized. And especially for agentic payment, stablecoin is, from my point of view, the only means that will work. Because on the deposit side, you would have to have every participant to agree to use the deposit as a payment mechanism, which from my point of view is not realistic. And the same for CDBC is not realistic. So in the agentic payment, stablecoins are the only means. And you can also argue, especially for smaller currencies, that smaller currencies have frictions today, because they don't have the liquidity pool, they don't have the FX rates, and what have you. Now, if you tokenize that, if you bring it onto a stablecoin, you take away parts of that friction that actually allows the smaller currencies to be nearly as efficient as big ones, strengthening actually their positioning. So I think there is, when you look at the trade balance, then you see a lot of interactions between Sweden, Europe, and the rest of the world. So cross-currency. There is a big case for agentic payments for all jurisdictions. And it actually, from my point of view, strengthens the smaller currencies because you are getting some of the frictions out of the process.
Maybe one day I will be able to buy Volvo in Swedish krona, AllUnity stablecoin.
Maybe. Why not?
Yeah, we'll see. We'll see if I decide to purchase Volvo as my car. Great. We have a good question from Kwan. It's related to the most recent news. So I would direct to both of you. So what's your view on the recent Bank of England policy on stablecoins? Does it go far enough?
Elie, are you on top of the recent comment?
Yeah, honestly, I'm not very well informed on that. I think it was basically raising the reserve limitation, so allowing stablecoin issuers in the UK to hold up to $40 billion before they become significant, or before, let's say, so allowing stablecoins to actually grow within the UK ecosystem. But I'm not very well informed to actually discuss this point.
Yeah, me too, Kwan. I would have to double check on that one. I would have to come back on that. I think ultimately the significance thing is not an ultimate showstopper as long as you have a level playing field. Yeah, and everybody who issues under the same regulation should have the same rules. And it brings more security to the market. I think there are certain discussions in various jurisdictions. Switzerland also quickly had this discussion around documenting every user transaction globally. Such a notion would kill it because that's technically possible, but financially impossible to actually fulfill. But on that one, sorry, I have to double check on that.
All right. So Kwan, sorry for not giving you the answer you maybe hope for, but don't worry. Stay tuned and you will get your answer. Guys, let's move to the distribution block of the show. So it's the last one for today. So I just wanna remind our audience to ask one or two more questions because we're gonna wrap up soon in 5 to 6 minutes. So right now we've seen the integrations between, let's say, Meta and USDC, so the paying the creators in Circle stablecoin, also Tempo and Morpho. So distribution is moving to the app layer and largely dominated by the US players. So my question for both of you is Europe structurally lagging this trend? And is there a potential to minimize the gap between what we are seeing in the US and what is currently existing in Europe? Elie, I'll start with you.
Yeah, thanks. So is Europe lagging today? Yeah, I think definitely. I think, again, echoing on what something Aleksandar touched upon earlier, is we still haven't seen banks actually distribute wallets to their customers at scale. And I think this is what's needed. But if you think about, okay, how difficult it is to actually integrate wallets, integrate the on-chain transactions into today's banking infrastructure, so the core banking infrastructure that exists today, then it becomes like a very difficult challenge to imagine that every bank must go and do this. So I'm going to take this question to actually explain a bit what we're trying to do with Meridyan. So what we are trying to do with Meridyan is simplify this integration as much as possible to banks. So what we're doing is we know that banks took the last 20 years to implement ISO standards so that they can standardize the communication with SWIFT and SEPA. And so we today when we say okay to banks, let's execute transactions on the blockchain, that means that you have to create a new way of how does a customer generate an intent, and how does that intent then results in the execution on a different network, which is the blockchain. And so what we're doing with Meridyan is we're actually saying to banks, okay, you don't need to change how the origination of the message of an instruction, of a payment instruction or tokenized security movement or an investment is done. Keep doing it the same way. Keep using your ISO messages. Keep using your fixed standards, but send those messages to us instead of sending them to Swift, and then we translate those messages and then we execute them on chain. That's a part of what we're doing. And another part that we're also doing is we're embedding wallets with IBANs. So and doing that on the blockchain level. So now if a bank or if a stablecoin issuer would like to use our technology, then basically they can allow their customers to still do IBAN to IBAN transfers, but instead of, let's say, that transaction being then executed over Swift and SEPA, it gets executed on the blockchain through our system, and then we are able to map that through thing. And I think delivering such technologies to the market is definitely going to be what is needed to unlock banks adopting blockchains at scale. Today in the US, this is being solved outside of banks, like you said. So Stripe going really hard on that market, right? So they acquired Privy, they acquired Bridge, they're building their own network. And I think here in Europe, what we need to do is we basically need to deliver similar type of technologies to the banks so that they are also able to do on-chain transactions without having to rebuild their entire core banking infrastructure. That's our value proposition.
All right, Alex, the floor is yours to dunk on the question.
No, I'm 100% with Elie. I think that is direly needed. Whether it comes too late, I don't know. Yeah, not meant to Meridyan now, Elie,
No.
but generally speaking, because the stripes of the world, they have a few years in advance. I mean, they are not just formed yesterday. We tend to forget that, that we celebrate and argue and tear around on that one, but they are there for a couple of years. And in Europe, we're really speeding up since what, 1.5 years or 1 year. Yeah. So you got to put this in perspective. Now, will it still be enough time for us to catch up? Very difficult. And that goes back to just the investment money that you get in Europe.
Exactly.
Yeah. Everybody is complaining. Politicians are complaining. Companies are complaining. The banks are complaining about lack of innovation. But when it comes to money raising from exactly the players who are complaining about lack of innovation, you have to fight for every million, and you have to explain why marketing costs in year 5 go up 2%. This is ridiculous. Yeah. And as long as that attitude stays the same, you won't see this in Europe, unfortunately. And the time for us to build it and compete with the ones who have now the big money pockets and can really push into the European market, unfortunately, that ship has sailed. And I'm fully with Elie. If we don't find a way that makes it very easy for the banks to onboard into that one, you will see a lot of banks dying over time.
Yeah.
Yeah.
And we don't want that. But I still genuinely believe that the opportunity to build and to actually go fast with this exists. Today, Europe has a lot of talent, best universities in the world, best developers, best product people. We've shipped products before. We know how to ship technology. And it's just a matter of unlocking the right funds to actually do it. So, yeah.
100% agree, Elie. 100% agree.
Yeah. So it's the problem is deeper than just the access to technological solutions, because we have that. It's about money and actually how easy the money flows. So the US has been the winner in that vertical since I don't know, since the World War II probably. But thank you guys so much for this discussion. Questions were very nice. So thank you the audience for asking them. What can I say? Alex, I owe you a beer when I'm in Frankfurt, and Elie,
Your beer's on me.
catch up with you later, friend. Yeah.
All right.
See ya.
Thank you
Have a
much.
nice
Bye.
Thursday, and catch you later.
See you
Bye,
later.
guys.
Bye.
Bye,
Bye-bye.
everyone.